Now, in the sector spotlight, I'm going to talk about the banks. The banks have been the focal point for 2 years. Everyone's been saying the banks are lagging. The banks are a headwind to the market. The banks have all of this horrendous paper from the mortgages. Bank of America, everyone, was talking about yesterday because, this is what happens when you kick the can down the road. This is what happens when you don't deal with certain situations. And I myself tried buying Bank of America yesterday, and then I was like, you know what? I'm staying away from where the fire pit is. I don't care. I didn't buy it at 15, 12, below. It even hurts if you tried to buy it through, 7. There was news of, AIG suing them, this and that. A lot of things from Countrywide are coming to, home to roost. So that's what happens when you try and, support something that can't be supported. I remember back in the day, they did a secondary for like $2 billion, and then things got even worse, so they just took them over instead of just writing off a bad situation. You have to take your medicine, take the loss, and then get stronger, not throw more good money after bad. But anyway, if you look at Bank of America, this has been a trouble spot. This is actually the weekly chart. When it broke this 9, it was another level. It came into about 651. If you look here from a technical standpoint, some might try and play, a bounce into this support. This was your, the low of 2009. Look how close we are to there. If you look at the daily chart, you'll see even how much, more disgusting this is. And it's very unfortunate because there are a lot of good people that work there. I take the ferry every day with guys who can't believe that their options are a hell of a lot higher. So the banks and the bank employees aren't making out like bandits right now. No one's making out like a bandit right now in the world because of the structural problems. Morgan Stanley, even after reporting a really good quarter, they got crushed yesterday. So even a professional trying to buy it, I tried buying a little bit of the dip yesterday. Look what happened here. Morgan broke another key level, and hopefully gets a bit of a bounce today. This was a good quarter. Shows you how everything can get collateral damage no matter what. On a technical basis, when it broke this area, this was a sell. Right around here is when all the directors started buying, and now we're all the way down to 712. I guess if you wanted to position in Morgan, you watch the low of yesterday, which was about 1695, and we open up. If it trades through that low, you get out. If it comes back above, then at least you have a calculated plan. What's going on right now is they're pushing everyone around. Even the strongest stocks with the best fundamentals that have no debt are getting punished with the market. That's what happens. So that's why you have to keep it small and keep it simple. Goldman Sachs, which was the behemoth back in the day, has been also leading these banks lower. At this particular point, I was trying to find some support in Goldman. I have to go to the weekly chart. On the weekly chart, it just came into this 112 area. So I guess this is a spot to watch. If this area doesn't hold, I would think that there's no reason why it can't try and breach 100. So at this, if you think about where we were, versus the lows, to where we are now, it looks pretty damaging, but it's still, there's a lot of room there. If you go to the daily chart, you'll see that it broke a key level, so a lot of guys got out. Some people even made money short through this 125. This was a head and shoulders formation back in the day, which actually led to some of this weakness. Here was your left shoulder, the head, the right shoulder. When it broke 155, we talked about notes on selling Goldman, and I couldn't see what was coming down the road, but stocks usually know, and there you go, all the way down to this 115 area. So I guess if you want to have some exposure to these banks, and you had to, I would choose Morgan and a little bit of Goldman. And I'm not going to get into Wells Fargo, but if you want to have one that has, I guess, mortgage exposure, I would actually, I would take JP Morgan over Bank of America. The FAZs, which everyone forgot about, which has been a good active trading vehicle for some, it's the, the reverse to the banks going up. Look at the size of this move if you just follow technicals. People were talking about buying this above, 51, and this just had a move to 80. So there are things that are working on a technical basis, as they break out and stocks break down. So as a professional, there are things to do. Obviously, as an active investor, it's hard to play these double and triple ETFs because usually they're programmed to go to zero, and a lot of them don't correlate, so you have to be careful. But all in all, the banks have been a problem. And in a tape like this that has changed, where we're probably going to get some kind of counter trend move, everything might not go with the move. So you have to be that much more selective. Right now, the banks are a problem spot. So if we do rally and these banks don't rally with the markets, we will see that we might make another leg lower. So we're going to have to watch those technicals closely. This is a dangerous time Not everything should be invested in. If you have to have a little bank exposure and you're a 5-10 year time horizon, I would say stick to maybe Morgan and Goldman or one of them, and then either a Wells Fargo and a JP Morgan over the Bank of America. And I'll go over some stocks or companies rich with cash that people are thinking about parking their money, but we have to take a look after this break.